Hey guys, Derek Ifasi here. Today's topic, I want to discuss how much do you need to retire at age 55. So this is meant for the individual that may be nearing age 55 or currently age 55, and they're trying to figure out, can I just be done with working? And how can I make sure that if I stop working, that I'm going to be fine regarding what my income's coming to me, regarding what my assets are, and what are some of the most important steps that you need to take in order to accomplish this goal, in order to make sure that you're planning for this goal properly. If you avoid these mistakes, that could result in obviously retirement success. If you make any one of these mistakes, it could be devastation. It could be devastation to say, hey, I wanted to retire at 55. I thought everything was good. And then all of a sudden in your 70s, you ran your well dry. You ran out of all your money in retirement. So it's very important that you pay attention. At any point in time, if you want to speak with one of our advisors, we're going to have our calendar linked directly in the description of this video, or you could always call our 1-800 number that's up on the screen. It's 1-800-566-1002 and reference this video. So to get started, the three most crucial areas that you should be focusing on is your inventory, so meaning what are your current assets? How are those assets being taxed? Is it in a non-qualified account, a taxable bucket? Is it in a tax-deferred account like IRAs, 401k accounts? Or are they in tax-free accounts? Meaning that when it comes time to start pulling out those dollars, you could pull them out in a tax-free manner. Also, what are your income sources going to be at that age 55? Do you have pension income streams? Do you have income streams from an inheritance, from a trust, from rental properties? Different things that will associate or incorporate how much income that you're going to be receiving at that age 55 and above. So maybe you could have a step up in income. Case in point would be Social Security income. Social Security income, you could take it as early as age 62 at a reduced benefit, or you could wait until your full retirement age, which is typically around age 67. Or you could wait till age 70. So how does that come into the mix? And then really the crux of everything are your expenses. So what are your expenses going to be at age 55? Are those expenses going to increase at age 55 and onward? Are you going to want to travel for the first few years throughout retirement? Do you want to kind of scale back a little bit? Are you going to have a decrease in expenses at that point? Maybe your mortgage will be paid off at that point. So I'm going to really go into the details off of inventory, income, how to basically mesh those together, and then coming up with some sort of strategy when you're comparing that against your expenses to make sure that you could have that retirement success. So what are your current accounts? And then also, how are those accounts being taxed? There's really three main areas on how an account can be taxed. It can be taxed on non-qualified monies or taxable. They could go into a taxable bucket. They could be in a tax deferred bucket, meaning that you're deferring when those taxes will be paid, and then also a tax free bucket. This is crucial to understand because if all of your dollars are, let's say, in a tax deferred bucket, meaning that when you start pulling them out, once you hit your ideal retirement date, that could mean significantly less dollars that you'll actually be able to net. So by making sure that you're positioning your buckets properly in between the taxable, tax deferred, tax free portions, that could allow you to optimize what your income streams will be throughout retirement and how much monies you could have in your leftover side. The main goal is to make sure that you're always going to be receiving some sort of baseline, and that baseline is going to cover what your expenses are every month throughout retirement for either you or your spouse. Once you create that baseline, whatever you have left over is now your fund monies, your growth related monies. And that's where you can have some fun with it. You could create that towards some sort of, taxable conversion, some tax-free conversions. You could create a type of inheritance maximization. You could create a type of slush fund that you're utilizing as a vacation fund. So there's a whole slew of different things that you could do. But understanding your current accounts, if let's say somebody has dollars in a savings account or a checking account, that's considered a taxable account. Or maybe they have it in a brokerage account, a non-qualified brokerage account. That's a taxable account. Meaning that any time that you either sell a position or you have some sort of credit that's that's given to you, let's say a savings account or a bank CD, you may get a 1099 at the end of the year showing you that yes, you had a gain, but now you have to pay some sort of portion of tax on those dollars. Those monies are typically very liquid, but you could still be getting hurt when it comes from a taxation standpoint. A tax deferred account An example of this would be your 401k or your IRA accounts. These are monies that you never paid tax on. You may have gotten a tax deduction on these accounts, meaning if you place contributions into your 401k, into your IRA accounts, you received a tax deduction. Those monies are growing tax deferred. When it comes time to start retiring and start pulling those dollars out, they're going to be fully taxable. And then you have your tax-free bucket. So that could incorporate different Roth IRA accounts, Roth conversion related accounts. It could include cash value life insurance accounts. So there's a slew of different ways on how you can make sure that you're positioning your buckets in the correct areas so that when you fast forward and you hit your ideal retirement date and you say, hey, I want to retire at this age 55 marker, what are the best possible ways to start pulling these monies out, and from what accounts, what buckets should you be taking these out to make sure that you're not shooting yourself in the foot. Shooting yourself in the foot, what do I mean by that? Well, if let's say all the money that's coming out for your retirement income is going to be in the tax deferred bucket, that tax deferred bucket could increase the amount of taxation on your Social Security income. So therefore, if it's placing a hole in, or you're going to be netting less dollars on your Social Security income and netting less dollars of your retirement income because you shoved too much money in your tax deferred bucket, that's obviously a problem. That means that you're going to have to, if tax rates increase, you're going to have to pull out more monies to incorporate for that tax increase. When you're pulling out more monies, therefore that could have a larger impact on your Social Security income. So there's always going to be some sort of connection, some sort of trickle-down effect. By making sure you're segmenting your dollars properly, you could avoid that common mistake. The next step is incorporating what is your cash flow going to be at age 55 and above. So are you going to be receiving, and like I have displayed, pension income? Are you trying to take out withdrawals from your 401k, your 403b, your 457, your thrift savings plan accounts? Are you trying to pull out monies from your IRAs? Now be mindful, if let's say you're triggering income from a pension, those dollars are going to be fully taxable. If you're taking monies from a 401k, a traditional 401k, 403b, 457, or thrift savings plan, you have to sever employment and leave dollars in those buckets in order to be able to access those at age 55. So the common mistake that's made is somebody would take those monies, they would roll it over into an IRA, and then just try to take out distributions as needed. There are ways on how you could pull out monies starting from age 50 from IRA accounts, known as Rule 72T, but you have to be very careful. There's rules behind it. So that might not give you the amount of income that you need to cover what your expenses are if that specific stretch that you have to take out on incremental steps does not qualify or does not incorporate with the combination of what your other cash flow streams are. So pension is probably going to be the most common. If let's say somebody gets access to their full pension and they're below the age of 55 or at that age 55, that's at least going to be some sort of lifetime income source, or could be some sort of lifetime income source for that individual or that individual and their spouse. The other routes, you have to be very careful with how you're pulling them out and make sure that you're layering them out properly. As an example, if you know that you have to take out X amount of dollars between 55 to 60, because you have these other portions of dollars that are going to be coming to you at age 60, make sure that you're laddering it out properly. Even if that means you're leaving it in a cash position, dividing by 5 as an example, to make sure that you're able to accomplish what that goal is and not have those specific dollars subject to some sort of market risk. That might be a viable solution. It might not be the ideal solution, but it could still be a viable solution. At age 60, you might have a certain step up of income or eligibility to start to take out more dollars from some specific types of accounts. At age 62, at age 67, if you want to trigger Social Security income, those could have further step-ups of your income. So really figure out what your guaranteed cash flows are, and then is there a specific gap there that you need to pull out more monies? If you need to pull out more monies from that gap, how do you make sure that you're doing it properly? Also, some individuals may be, fortunate enough to have a trust fund where they're receiving income constantly because of a trust that was set up from a different family member. Maybe you came into some sort of inheritance and that inheritance is getting paid out to you for X amount of years or in the form of a lump sum. So that's more in your taxable bucket. The sale of a business. Sometimes when somebody sells a business, the terms of that sale might be, okay, I'm going to be receiving income for the sale of this business for the next 10 to 15 years. So that could be leveraged as a sort of laddering strategy. Real estate income. Maybe you own some different real estate and you're receiving cash flow from your real estate ventures, and that's going to incorporate or add to your cash flow within those buckets. So really just try to take an inventory of all your different cash flows and then earmark them. Say, okay, this is X amount, this is $30,000 over here, this is $20,000 over here, and add those up and add those up. At the end of the day, how much of this is guaranteed income? How much of this is just speculative income where that could, have a significant reduction? And then also, how much of this income is taxable where maybe you did not incorporate that? As an example, let's say if you have a pension that's coming to you for $50,000, but you didn't realize that that pension was fully taxable, you're not netting that $50,000, that full $50,000. It's going to be after taxes. What is your tax bracket at that time? What is your net going to be? So, and then also cash value life insurance distributions. These are things that you could, if you've set up monies into a cash value life insurance policy and you've done it a proper way and you want to start removing dollars in the form of tax-free loans, you could do that. And that's another way to start taking dollars out at age 55 or later, 55 or above, to make sure that you're giving even higher amounts of cash flow throughout your retirement. This next section, I believe, is probably the most important when you're trying to retire at age 55, and it's really understanding what your expenses are. In order to accomplish your specific goal, in this case, your retirement goal, your retirement income goal, you have to know where you're going. By understanding what your expenses are and getting very detailed with that number, it allows you to have that peace of mind to make sure that you're controlling your other chips the correct way, that you're creating a strategy, creating a plan. You're not just looking at retirement as a number. You're not just saying, okay, I saved up, $2 million. I saved up $500,000, and that seems like a lot. This seems like a large number, so I should be good. And that's a common mistake that individuals make. They don't actually know where they're aiming towards. They don't, it's like throwing darts at a random wall trying to hit a bullseye, and you're not even looking at the board. So this is where I want to show you different ways that could help you understand how to calculate your expenses. The first way is a little bit more vague, but it still is a strategy. And it's known as the acronym of MUG, and it stands for mortgage, utilities, and groceries. So maybe at age 55, you're going to have a specific expense of your mortgage expense, and maybe that expense is going to teeter off once you start getting in your 60s. Really understand what that number is and also what's incorporated in that number. So maybe you have your mortgage that's paid off, but you didn't incorporate that you're also paying, $10,000, $15,000 of taxes on your home every single year. Well, you can't just say, okay, the mortgage is paid off, so therefore my housing expense is going to go away. What exactly are those different expenses that are incorporated with the house, with the mortgage? Utilities, which obviously has a vast array of different expenses in there. What are the generic expenses regarding your utilities, and then your groceries? How much does it cost you to eat every week? How much does it cost you to go out to eat every week, or some sort of form of entertainment? So by utilizing that generic concept, yes, you could get an ideal ballpark of a number, but it's not going to be super accurate. It's definitely a baseline, and it's better than just guessing. But I think that there's some other areas that are a little bit more detailed on how to accomplish this successfully. The next stage would be saying, hey, I'm receiving $100,000 from my occupation right now. That's covering both mine and my spouse's expenses. That's the number that I want to hit. So you could always line up what your current income is and then try to say, this is what I need in retirement. And if you have more than enough income streams and different buckets that are, could create that successful outcome, yeah, you can retire. You can really ride off into the sunset and know that you could stop working if that math adds up. If you're able to receive, let's say, $70,000 from pension income and get another $30,000 of savings and ladder that out until you're triggering Social Security income at age 62 or 65 or 67. There's different ways on how to do that, but just make sure that you really are getting some sort of goal, some sort of baseline on those expenses. We do things differently. We have a detailed budgeting sheet where we really look underneath the hood and say, okay, what are your expenses right now? What are your expenses projected to be? What are the different things that you want to do throughout retirement from your ages 55 to 65? Or do you want to travel more from age 65 to age 75? Do you want to reduce the amount of travel or maybe increase that more? Maybe you want to downsize on your house and be closer to your kids or your grandkids. what does that retirement vision really look like? And then how can we put it to paper? How can we make sure that we're itemizing what those expenses are? And it's not really complicated. All it is just math, a 4-letter word, math. What exactly do I need to get to? How can I possibly create a strategy to overcome what my expenses are? Comes down to math. So now you have a general sense on how you should segment your inventory into either your taxable, your tax deferred, or tax free bucket. You have a general idea on how to incorporate what your income sources are, or what are some different buckets that you could pull from to create different withdrawal strategies, and then also understand how to create your expense related number. The expense number is really, figuring out what your vision for retirement is and then scaling back into the math. But what are the solutions with this? And this is really meant for the individual that's a do-it-yourselfer that says, hey, I just want to know how to make sure that I'm covering these 4 main areas, or I'm taking advantage of these 4 main steps. Or obviously they could reach out to us and we could walk them through how to do this properly. But the first solution is figuring out your expense number. I mentioned that we have detailed analysis on different budgeting sheets, and we try to help you dream in retirement and really paint that picture so that it could put you in that destination. It could put you in that that realistic scenario, and then scale back and say, okay, what would this expense cost? What would this expense cost? You could leverage the acronym of MUG, which I mentioned, mortgage, utilities, groceries, to get a baseline. Or you could just say, okay, I'm receiving X amount of dollars of income. I want to take all, I want to make sure I'm receiving that same amount. Why all I need is, half this number to cover our expenses, throughout retirement. So figure out what your expense number is and utilize that as your baseline. From there, create tax efficiency within your current accounts. So if, let's say, you're about 5-10 years out and you really want to retire at the age 55, we'll see what your current trajectory is. Are you placing monies into taxable accounts? Are you placing dollars into tax deferred accounts? Are you placing monies into tax free accounts? By utilizing dollars into tax free accounts, it makes your retirement situation and retirement plan significantly easier. So you could utilize things such as Roth conversions and say, okay, I have a slew of money sitting in these IRAs that I know is going to end up hurting me later on. How do I make sure that I'm creating some sort of Roth conversion related strategy on this? Or maybe you want to start contributing to, if your employer is offering you a Roth 401k. Rather than taking advantage of the low tax rates currently, how do you make sure that you're paying your taxes now so that you're placing those dollars, those contributions, into tax-free buckets and utilize those tax-free monies later on? If maybe you're not offered a Roth 401k through work, but you want to create a Roth IRA, you could do that. You could make sure that you're staying underneath your contribution limitation and segmenting dollars towards some sort of contribution amount into that Roth IRA. Maybe you make too much money and you phase out of a Roth IRA. So therefore, you're trying to do something known as a backdoor Roth IRA contribution technique. There's different ways on how you could segment cash value life insurance. Even though obviously individuals might not need life insurance, especially when it comes to their retirement planning needs, but there's ways on how you could reduce what your expenses are, reduce what your death benefit is, so you're hoarding the most amount of dollars into those sorts of accounts, getting tax-free growth, and then being able to pull your monies out tax-free. The reason why I incorporate the Roth conversions or the Roth IRAs and the tax-free distributions from the life insurance aspect is because when you're taking monies from those sorts of accounts, it will not hurt, or currently as it stands, it does not hurt your Social Security taxable income. It does not incorporate your provisional income, the different calculation on what will determine which portion of your Social Security income is taxable. So by making sure you're taking monies from these tax-free buckets, it could allow you to net more dollars in your pocket, but then transition to you receiving tax-free income from your Social Security income and not having to pay up to that 85% of taxation on your Social Security income, which you've may have heard unfortunate instances on. So really get very clear on how you could create some sort of strategy, whether you're nearing your retirement date or you have a long time horizon from that retirement date, and making sure that you're incorporating the best possible buckets on a tax-free manner as opposed to the tax-deferred or taxable bucket manner. Also, close up the gaps between your income versus expenses. By making sure that you're having some sort of baseline, that's going to give you that retirement success. It's going to give you that retirement confidence, saying, okay, I understand what I have to get to. And based on what my situation is with the pension income streams that are coming to me, or all those different, cash flow income streams that are coming to me, I might have a gap there between what that income is versus my expenses. Create a strategy to close up that gap. It could be as simple as placing dollars into non-risky accounts and making sure that you're living off of interest, or you're just keeping it in cash-related positions and trying to filter those monies to you on some sort of laddering strategy before you could dip into your IRA and your 401k related accounts. Make sure that you have some sort of concrete strategy to close up what those gaps are. And really the crux of everything is to try to leave as much money in your growth related bucket as possible. So if you don't have an income plan, create an income plan, but do it using the smallest amount of dollars and only as much as necessary, so that you could place a portion of dollars towards your safety, towards your emergency related needs. And typically rule of thumb is about 3 to 12 months of whatever your expenses are. You should leave it in some sort of liquid account to make sure you could touch on it in case of an emergency, in case of an oh my gosh moment that was to occur, and then have the most amount of monies into some sort of growth related strategy. So maybe somebody has savings of $1 million, just to keep the math simple. And based on what that individual situation is, it requires $300,000 to get placed into different income related strategies. Maybe so that means now you have $700,000 remaining. And that $700,000 remaining, it may require $50,000 to get placed into some sort of emergency related need. So now you have $650,000 remaining. That could be an excellent scenario, especially as you're nearing retirement, or you're dipping into that retirement stage, to leverage the different Roth conversions to really maximize what your legacy play is, maximize what your legacy, estate planning needs are. There's a whole multitude of different ways on how to really skin that cat, but make sure that you're not placing too many dollars towards your income and your safety buckets, so you're able to have as much fund monies in those ancillary buckets, really known as the growth buckets. And that doesn't mean that you have to segment risk towards your growth related buckets. That could mean saying, hey, I have this $650,000 remaining, and I want to make sure to be super aggressive with $150,000 of this, and I want to be super conservative. I want to take $250,000 and place it into the highest fixed related account. I want to take another $250,000 and create some sort of index and relating strategy on that sort of account, or leverage $250,000 and really create this towards some sort of legacy maximization goal. So there's a whole slew of different ways on how you could do that. It's just being very calculated with your approach and not overstepping, not trying to utilize a jack of all trades type product, a jack of all trades type account, being very measured, with your approach. Slow and steady wins the race. And that's something you always have to remember. Understand what the math is involved, understand what your strategy is, what portions of your strategy could hurt you, and then how can you leverage your current situation to make your retirement planning needs that much better. So in closing, obviously we covered a lot of different areas. One of the trademark strategies that we have in-house is known as the retirement diet plan. And it's 4 major steps to make sure that an individual could properly retire. Make sure that their income is greater than or equal to their expenses, making sure that they have an ample amount of emergency needs, and then also making sure they have the most amount of dollars in their growth-related bucket. Doing this in a tax-effective manner, making sure that if somebody wants to leave assets to their beneficiaries, they're doing that in an efficient and effective way, and then also growing their accounts through some sort of investment strategy that's based on what their risk tolerance is. So those 4 main areas are crucial. You're eligible for a free 20-minute strategy session by either giving our 1-800 number a call. It's 1-800-566-1002 and referencing this video, or clicking on the calendar link and mentioning this video and saying exactly what sort of advisor that you'd want to speak with, and getting an inventory off of your current situation. Many times we'll talk to somebody and they're in a fantastic scenario where we just say, hey, listen, there's nothing that you should do. There's no reason to hire us. There's no reason to go and mix around anything regarding your accounts. And then on the opposite side, there's many times that we do deal with individuals on a daily basis all across the country to make sure that they're being put in the best mathematical position. They're having that confidence. They're knowing that by utilizing the retirement diet plan process and utilizing one of our advisors, they could be put up into a very good situation and have that confidence and really enjoy their retirement and not just leave it to chance, not just have that question mark. So I want to thank you very much for watching this video. Also, feel free to visit our website. It's ifasifinancial.com or retiresharp.com. They both bring you to the same place. And subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.